Almost all individuals and firms use banks in their daily lives and operations to keep the majority of their cash safe. Not only does a bank protect one's cash from theft, but also provides great sources of independent record keeping, particularly for companies with large and frequent inflows and outflows of cash into their bank accounts. These records illustrate the cash balance of the company through their transactions, which leads us to the concept of bank reconciliation. This is where companies utilise these bank records to compare them with those of their own. This allows them to establish recognition of the differences between their cash balance recorded by the bank and recorded in their own company records. So what are the primary benefits of bank reconciliation apart from recognising potential disparities in account balance? Well, firstly, it confirms the accuracy of both records, which can allow companies to refine their transaction recording process. As well as this, it determines actual cash balance to be reported on the statement of financial position by the company. But how is a bank reconciliation actually prepared or carried out? Let me explain the 3 key steps to you. Firstly, one must reconcile the bank balance. This is where the cash balance reported on the bank statement is adjusted to the company's actual cash balance. Often the two balances will differ and therefore need adjusting. Why does this occur, you ask? Because of 2 main reasons that are not reflected on the statement itself. First of all, a deposit in transit may have been made by the company but is yet to appear in the bank statement due to it having not yet been cleared by the bank as of the statement date. Secondly, outstanding checks that have been distributed by the company yet haven't appeared on the bank statement may occur due to the same issue of the bank having not yet cleared this transaction by the statement date. Let's not forget the other reason why there may be errors in the bank balance. Simply, errors made by the bank themselves, such as inaccurate numerical recording. However, this is also easily resolved through adjustments to the bank balance to equal the actual cash balance reported by the company. Our second step in the bank reconciliation preparation process is reconciling the company book or ledger account balance. A company's book balance may differ from the actual balance, therefore requiring adjusting. This occurs for 2 reasons. The first being bank activities that can change the cash balance yet are not recorded by the company. We call these credit and debit memoranda. Credit memoranda relates to banks collecting cash on behalf of the company, whereas debit memoranda is notification of a subtraction from the cash balance on the bank statement. Our second reason for difference in book balance recordings relates to errors made in the company's cash records themselves, a standard accounting error that can be solved through adjustments. Finally, after this, the third step in the bank reconciliation process leads us to adjusting the cash balance itself. Once both our bank and company book balances are reconciled itself, we can adjust the company's cash balance to the actual cash balance as determined by reconciliations made in the first 2 steps. Hereby, journal entries must be recorded in the final step in the process to adjust the company's book balance to the actual cash balance. After all this is completed, the process of bank reconciliation has been achieved.